The central bank on Wednesday supported its 10th financing cost expansion in somewhat more than a year and dropped a conditional clue that the ongoing fixing cycle is at an end. In a consistent choice generally expected by business sectors, the National Bank's Government Open Market Board of Trustees raised its benchmark getting rate by 0.25 rate point. The rate sets what banks charge each other for short-term loaning yet takes care of through to numerous purchaser obligation items, for example, contracts, vehicle credits and credit cards. The increment takes the Fed subsidizes rate to an objective scope of 5% to 5.25%, the most elevated since August 2007. Markets, however, are more centered around whether the Fed will stop here, especially with waiting worries over monetary development and the financial emergency that has shaken nerves on Money Road. Stocks rose somewhat and depository yields were for the most part lower quickly following the Fed news. However, stocks battled to clutch the gains. During Wednesday's news meeting, Director Jerome Powell said, "A choice on a delay was not made today," yet noticed the adjustment of the assertion language around future strategy firming was significant. The post-meeting explanation had just offered some lucidity on the future speed of rate climbs, and not by what it said but rather what it didn't say. The record precluded a sentence present in the past proclamation saying that, "The Council guesses that some extra strategy firming might be fitting for the Fed to accomplish its 2% expansion objective." The assertion likewise changed language to frame the circumstances under which extra arrangement firming might be proper. Already, the FOMC had outlined the forward direction around how it would decide the degree of future expansions in the objective reach. The assertion emphasized that the Fed will consider the total fixing of money-related approach, the slacks with which money-related arrangement influences monetary action and expansion, and monetary turns of events. Taken together, the moves are basically a questionable gesture that while tight strategy could stay essentially, the way forward is less clear for real loan cost climbs as policymakers survey approaching inflation and monetary conditions. Tighter credit for families. Wednesday's choice comes in the midst of U.S. monetary delicacy and over the protests of noticeable majority rule legislators, who encouraged the Fed for this present week to stop rate climbs that they demanded could cause a downturn and exorbitant loss of occupations. In any case, the work market has major areas of strength for stayed. The increments began in Walk 2022. Simultaneously, expansion is still well over the 2% objective that policymakers think about ideal. Numerous authorities have said rates most likely should remain raised regardless of whether the climbs are required to be postponed. Expansion has directed to some degree since the center of last year. In any case, expansion compels keep on running high, and the most common way of maneuvering expansion down to 2% has quite far to go, Powell told reporters. Along with expansion, the Fed has needed to manage tumult in the financial business that has seen 3 medium-sized banks covered. However, national bank authorities demand the business overall is steady. A normal fixing in credit conditions and elevated guidelines ahead are supposed to weigh further on monetary development that was simply 1.1% annualized in the main quarter. The post-meeting proclamation noticed that more tight credit conditions for families and organizations are probably going to burden financial action, employing an expansion. The language was like the Walk explanation, which came soon after the breakdown of Silicon Valley Bank and Mark Bank. The Federal Reserve's own financial specialists at the Walk FOMC meeting cautioned that a shallow downturn is logical because of the financial issues. Issues in the monetary area have proceeded, with JP Morgan pursue on Monday assuming control over First Republic. Powell said such an exchange was an special case. Albeit it was anything but a very smart arrangement, Powell said it was a great result for the banking system. The explanation from the current week's gathering likewise repeated that monetary development has been humble, while work gains have been hearty, and expansion is raised. Albeit the FOMC articulation is somewhat more timid by what it left out from the last assertion. It regardless clarifies that the Fed remains information reliant as it recognizes that expansion stays raised, however highlights that it needs to screen the combined impacts of its forceful rate climb crusade, said Quincy Crosby, boss worldwide specialist at LPL Exploration. The assertion gives a strong stage from which the Fed can move toward any path without unduly astonishing business sectors, Crosby added. Higher rates added to banking issues while higher rates have intensified the financial issues, took care of authorities' demand they assented solidly around expansion. However, late information focuses have demonstrated a conditioning in cost increments, tacky things, for example, lodging expenses and clinical consideration have stayed higher, while costs that will generally change a ton, like food and energy, really have decelerated, as per Atlanta took care of computations. Markets are guessing that more slow development and the chance of downturn will compel the Fed to cut rates.